everyone, and welcome. If you're an American living abroad with kids, you're gonna want to pay close attention. We are about to break down a specific tax choice that could literally put thousands of dollars in cash directly into your bank account from the IRS. So let's just start with a question that sounds, well, impossible, right? Can you owe $0 in US tax, but still get a check from the government? It seems crazy, but the answer is a definite yes. And honestly, it's a huge opportunity that a lot of expat families completely miss out on. And this is the number you need to remember. We're talking about a potential cash refund of up to $1,700 per child per year. And let's be super clear, this isn't a deduction that just lowers what you owe. Nope, this is a direct payment, actual cash from the US Treasury. So, if this money's out there, why do so many people miss it? Well, it boils down to what I like to call the Expat Refund Paradox. See, a lot of expats do everything right to get their US tax bill down to zero. But in the process, they accidentally slam the door shut on receiving this cash refund. And this is probably the most important thing to get your head around. Getting this money isn't automatic. It all comes down to a single choice you make when you file your taxes. The problem for most people isn't a lack of qualification. It's that they choose the wrong tool for the job. All right, let's get into the specifics. The tool at the center of all this is the child tax credit. And understanding how it works, well, that's the key that unlocks the cash. Okay, so for the 2025 tax year, the total child tax credit is worth up to $2,200 for every qualifying child you have. Simple enough, right? But here's where it gets interesting. That credit, it's actually split into two parts. You've got the non-refundable part, which, just reduces any tax you might owe. But for expats, the real magic is in the refundable part. Its official name is the Additional Child Tax Credit, or ACTC. And that's the part that can come back to you as cold, hard cash. So who qualifies? Well, these are the standard IRS rules. Your kid needs to be under 17 with a US Social Security number. You gotta claim them as a dependent, and you need to have at least $2,500 of earned income. The big takeaway here, these rules are exactly the same whether you live in Ohio or you live in Oslo. Your location doesn't change this part. Okay, this brings us right to the heart of it. We're talking about one crucial decision every American family living overseas has to make. And this single choice, it determines whether that refund door is wide open for you or if it's locked shut. You see, to avoid paying tax twice on the same income, you've got two main tools in your toolbox. The Foreign Earned Income Exclusion, we'll call it the FEIE, and the Foreign Tax Credit, or FTC. Your choice between these two has massive, and I mean massive, consequences for getting that cash refund. And this table just lays it all out perfectly. The FEIE lets you basically ignore a big chunk of your income. Great for people in low tax places. The FTC, on the other hand, gives you a credit for taxes you've already paid abroad. But just look at that final row. That's the knockout punch. Using the FEIE flat out disqualifies you from the cash refund. Using the FTC keeps you in the game. And right here, this is the aha moment. Let's connect the dots and see exactly why one path leads to a refund check and the other one leads to, well, nothing. The reason why is actually super simple, and it's a hard and fast rule from the IRS. It basically says if you use Form 2555 to claim that foreign earned income exclusion, you are automatically forbidden from claiming the refundable part of the child tax credit. That's it. That one rule is the entire reason we're having this conversation. So just so we're all on the same page, when we're talking about getting that cash refund, we are talking about the Additional Child Tax Credit, the ACTC. And the only way to keep that door open is to skip the FEIE and use the foreign tax credit instead. The math for the refund itself is pretty straightforward. You take your earned income, subtract the first $2,500, and then multiply what's left by 15%. That's your refund, up to that $1,700 max per kid. But the key phrase there is earned income. If you use the FEIE, you've excluded that income. So as far as the IRS is concerned, it's gone. You can't use it for this calculation. Okay, enough with the theory. Theory is great, but let's make this real. Let's look at two different expat families to see how this choice plays out with actual numbers. First up, we've got Rachel. She's a teacher in Qatar, a country with zero income tax. If she uses the FEIE, she excludes her income, pays zero US tax, and she's done. It's a no-brainer. If she tried to use the FTC just to get the refund, well, she has no foreign taxes to credit, so she'd suddenly owe thousands in US tax. For her, the FEIE is absolutely the right move. But now, let's look at David. He's a consultant in high-tax Germany. If he uses the FEIE, sure, his US tax is zero, but he's still paid about 32 grand in German taxes, and he gets no refund. Now watch this. If he uses the FTC instead, his huge German tax bill gives him more than enough credit to wipe out his US tax, and he stays eligible for the refund. So he pays the exact same total tax, but, and here's the kicker, he also gets a $1,700 check from the IRS. It's a massive difference. So what's the takeaway here? It's that this is not a one-size-fits-all answer. You absolutely have to have a plan based on where you live and what your tax situation looks like. So here are 3 things you can do right now. First, before you file, always run the numbers both ways. See what happens with the FIEE versus the FTC. Second, if you have a kid born abroad, get that Social Security number application in immediately. Waiting can cost you an entire year of credit. And third, if you're watching this and thinking, oh no, I missed this, you can actually go back and amend your tax returns for the past 3 years to claim the money you were owed. But, and this is a big but, you have to be careful. This is a serious decision. If you've been using the FEIE and you switch over to the FTC to get this credit, you generally can't switch back for 5 years. So you really have to plan ahead, especially if you think you might move between high and low tax countries down the road. So in the end, it all comes down to this. Your tax strategy isn't just about what you might owe, it's about what you could be getting back. By understanding this critical link, this cause and effect between your tax forms and your refund, you can make the right choice for your family and make sure you are not leaving thousands of dollars on the table.